Well, good morning, and it is great to see so many of you this morning for our business briefing. For those of you who don't know me, and there are a few, I'm Jeff Alexander, and I'm Chief Executive of Gatwick Diamond, and we're really pleased to be doing this business briefing in partnership with NatWest. NatWest are very close partners and supporters of Gatwick Diamond business. We've worked with them very closely over many years. And it's great to welcome Marcus back, Marcus Wright, Senior Economist at NatWest, who's going to lead the business briefing this morning. We have worked with Marcus before, so we know we're going to have really good value. I've been asked to say to you that it's best if you stay on mute, and when Marcus starts speaking, if you go into speaker view, you'll probably get a better experience, and then we can all come back together then when we do the Q&A. I think you have to agree that our timing for this event, for this business briefing, has been absolutely impeccable. You know, not only is it only hours since the Chancellor of the Exchequer made his statement yesterday, but it is 300 years, almost to the month, since the South Sea bubble. And as some of you will know, the current financial crisis is being compared with that. That's the last time we were in anything like as deep a pickle as we are in now. So excellent timing, if unfortunate in other ways. Marcus is going to go ahead and give his presentation. I know there's going to be plenty of time for questions. What we'd like you to do is to use the chat facility. So if you can post questions into chat, I will pick them up and then hand them on to Marcus. There'll also be an opportunity for you to ask questions live, but if you can start by putting your questions into chat, that would really help move things along. So, Marcus, over to you.
Thank you very much. Good morning, everyone. Been doing quite a few of these, and obviously similar to the rest, a shame in a number of ways. Can't be together in a room for a more traditional presenting experience, but we'll try and do our best here. So I'll set out some slides, which hopefully should be coming up on screen soon for everyone to see. I'm going to talk about a number of things, try and shed a bit of light on the outlook, so near term, or as certain as we can be. Forecasting is challenging at the best of times. Imagine trying to do it in this environment. It's safe to say this has been the most challenging period of my 16-year career. There was a period early in the year when I was doing forecasts and scenarios in the morning and changing them by the afternoon. And that feels like it's been on repeat in the month since. So touch a bit on that. There are various lenses to think about the recovery and angles to this. I'll try and touch on as many as I can. I certainly will touch on them all. So very happy for the discussion to be and questions to be as wide ranging as people wish in the subsequent Q&A. I've actually found on these that people maybe sort of are more sort of willing to ask the questions, maybe ask the tougher questions on Zoom rather than a face-to-face environment, which is great because I get plenty of good discussion. Right, okay. So play on this V, W, U, all the different shapes used by economists to describe the recovery, and as of the past few weeks, a vaccine-shaped one in a way. I mean, the interesting thing about this is, so I got lots of questions. Well, how does this change your forecasts? Just, you know, because we've got a lot of good news on the vaccine. We can see light at the end of the tunnel, and it certainly resonates deeply on a personal level amongst all of us that life can begin to return to normal, maybe perhaps spring, summer. The thing about it was any forecast out through next year did assume a vaccine was began to be rolled out over the course of next year. Because that's the only way you get a recovery back to bring output back to the level it was pre-COVID. That's the bottom line. And GDP data over the past few months has confirmed that. because momentum was coming out. The wind was coming out the sails of the recovery prior to this current lockdown, prior to restrictions that were dialing up through October. The wind had come out of the recovery already in many respects. And the message was, until restrictions are completely loosened, until people are free to readopt old habits, behaviours, and the choice they have to do that, you're just not going to be able to regain your pre-COVID level of output. So it was always in there. I think the way to describe the news of the past few weeks in the vaccine is I think it brings forward a little into 2021, the date at which sort of normalization begins, and of course gives us that bit more. You can be a bit more confident around your base case assumption, which, as I say, always had a vaccine in it. So anyway, on the next slide, try to, as you probably know, I try to incorporate pictures where I can, and this just speaks to the point that was mentioned up top about what's been happening, the sheer volume and news flow, and reasons to change forecasts over the past few weeks have been remarkable. Say second lockdown, spending review yesterday, news on the vaccine, and of course, away from these shores, so many things happening. Sort of primary amongst which is the US presidential election, its outcome, and the prospect of changing policy there. So lots to talk about. I'll touch on each of them at the appropriate point. Right, I think I'll jump into the next slide, get into the charts, and just set out where we are and where we're going. And so what this chart shows, so the top left, is just underlines this point about the scale of the decline. Lockdown, worst downturn in 300 years, which again mentioned up top. But yeah, reading some of the stories from that time and what exactly conditions were like, and it was climate driven, but it was not what's talked about in these times. It was the cold. So this was an extraordinary cold winter that brought about truly remarkable things. Upminster clergymen recounting events or detailing events saw fish frozen in the rivers and birds falling from the sky, and worst of all, barrels of wine freezing and bursting. So that was that was what was going on when the economic downturn was as bad as this. It barely warrants comparisons, a pre-industrial age, but it was just so long ago, so surpassing anything we've experienced in our lifetimes and before Great Depression. Now the rebound was strong through summer, June, July, opening up. It genuinely was, and the UK, while suffering worse than other countries in Europe, US, we did put together a strong recovery into the summer. It tailed off by August. That was clear. Eat out to help out, big help. Staycationing, big help in August. But away from that, you can see sectors really sort of struggling. As I say, momentum was waning, and that was underlined in September's GDP data as well. And so what this gives you, the chart on the top right shows, this disparity in sectors is truly remarkable. You never get this in any sort of downturn. You never get this level of disparity between sectors, where in some downturns, modest, negligible, and have since recovered, or are close to their where they were pre-COVID, while others are some way away from nowhere near their pre-COVID peak in outputs. And it's consumer-facing service sectors. It's what we all know, because it's all the things that we're not doing. Traveling, whether it's in this country or abroad, staying in hotels, going out to restaurants, gyms, theatres, cinemas, yoga classes, you name it. And we're just not doing it to the same degree as before. And so the impact on these sectors are severe, and it's where the eventual labour market fallout will hit most squarely. On the bottom left, just underline this point about the second lockdown. It will stick the recovery into reverse. So big decline in Q2, big upsurge in GDP in Q3, Q4 back into decline, but it won't be anywhere near what we experienced in Q2. The lockdown is just not having, it's not severe for one, because construction, manufacturing, education in particular, but most crucially of all, business adaptation. That's very clear, and we've all seen it. We're all participating in it. Business adaptation has come on leaps and bounds. So the downturn's just not going to be nearly as bad. It will be focused in November, and that will take off GDP. But Q4 will be a decline, a much more modest one, and then back to recovery in 2021. and the OBR's view yesterday, and we're in a similar place, looking at growth around the 5% mark next year after a decline of about 11% this year. So 5% in normal times is obviously truly extraordinary. That's more Chinese rates of growth, but you are coming off a rather shocking decline in 2020. Is it good, bad, and different? It's not too bad, but there is huge uncertainty around it. A lot of it simply comes down to the timing on the vaccine rollout and the uncertainties and variables around the vaccine, which are considerable, right? Let's be clear. It's not a kind of, a sealed deal. There's lots of uncertainties around, transportation, rollout, getting it to the most vulnerable people first. So there are quite a few moving parts there, but if it all goes really, really well, you can very easily end up in an upside scenario where spending recovers very, very dramatically and quickly because people go back to their old habits because they're desperate to pick up where they left off, going out as much, spending in restaurants and taking their children to play centres, etc. What would lend support to that? Well, there's cash on the sidelines. The savings ratios jumped sharply. We were simply unable to spend over the sort of spring and quite a bit of the summer. So that the savings ratio is basically the highest it's been pretty much ever. Safe to say that households will probably be more cautious than previous, and they'll want to keep a little bit extra on reserve. The savings ratio was very low, but let's be clear, there are billions of pounds sitting on the sideline ready to be spent, people desperate for holidays, and I say desperate to do the things that they used to do. So there is, there is a potential real upside to that sort of 5% growth figure because the rollout of the vaccine is really, really effective and quick, and it happens, it really does happen by Easter, and you get a roaring sort of back end, sort of 6-8 months of the year, so to speak. But on the flip side, and this is what I've set out on the chart on the bottom right, is from the viewed through the lenses of the CFOs up and down the land, and that's what this survey captures from the Bank of England. There's still pessimism around expectations on sales, the orange line, and expectations on cuts to headcount. So that's what CFOs consistently have been saying in previous months. I expect that in those lines to come up a bit in future iterations of this survey, but there are still plans to cut headcount, and touching it more on the labour market section. But redundancies, the pace of redundancies really picked up in late September and actually reached the peak. So the number of redundancies, 500,000 people were made redundant in the 3 months to September. And that is the peak post-financial crisis. So I think the dark days of early 2009. That's what we're experienced there. Right, on the next slide, what I tend to do here, use this quite a bit. There's lots of lenses you can throw on the recovery, different angles you can look at it, and this is an attempt to capture most, not all of them. So I've talked about growth, and we've talked about the vaccine, so the top two on the left, and mobility. So economists have been looking at these high frequency indicators. They are de rigueur in a COVID world to get a handle on how the economy is doing, because the traditional data is often with a considerable lag, and things have moved on a lot. So Google mobility data and Apple mobility data have been very, very useful. And what does it tell us? Car use is close to typical. It's a great way to socially distance, use a car and public transport. And we know that the deal required for TfL just down markedly, and down further still amid lockdown. So a long way to go on the recovery on that front. So just on the labour market and where we're expected to go, where we're at. So let's say redundancies picked up sharply in September, unemployment's at 4.8%. That's still historically low, and it is not nearly what people expected going back to earlier in the year. People had penciled in unemployment rates of 6, 7, 8% by now. What's happened? Policy has been tremendously effective. That's very clear. Job retention schemes have been hugely effective at preventing a labour market fall. The state has shown utilising its considerable ability to borrow, again underlined yesterday, and it's perfectly able to salvage and prevent those from experiencing very sharp drops in income. As we move through pandemic and think about, and in the workshop, there'll be discussions will turn to doing that in future universal basic income, because that's what the job retention scheme is really a form of, or it's an experiment in. But that's prevented the labour market fallout. And actually, given it's been extended to March, the whole point of it is to bridge the gap, right, to the pickup in activity so people can be reabsorbed back into the labour force. So the chances of that have increased given the news on the vaccine. You know, if we're talking about April rollout, there's potentially not much difference between those two things. So you limit the expected degree of the rise in unemployment. So earlier in the year, unemployment peaks were, there was 8s, there was 9s, there was 10%, you know, so blowing past what was experienced in the financial crisis, levels of unemployment not seen since the 1980s. Forecasts are not there now. You know, they're at that 7% mark, and that's short of where we went even following the financial crisis, which was a far less severe economic decline than the one we're seeing right now in terms of GDP. So 7% still bad. So unfortunately, a lot of people losing their jobs. It does imply another 750,000 people losing their jobs from here. But that's where the forecast is right now, and that takes place really. That's a 2021 story because of I'd say the success of policy. On the consumer spending side, so the final one in this left column. Sorry, can everyone still hear me? Yeah. Thumbs up. Yeah.
We can now, Marcus. We did lose
excellent.
you.
Sorry, just jumped out. That was odd. So yeah, look, retail sales can overstate the strength of the consumer, because this gets to the point. This is this compositional shift in spending. We're all spending less on services, and that's where 2/3 of consumer spending goes, right? You think, you know, consumer spending isn't just about goods, far from it. It's about what we spend on services. So I'll reallocate a lot of that into saving. A lot of it's gone into buying more goods, and so retail sales are actually above their pre-COVID level, which is remarkable. And again, that's something shared across developed economies. But I say that don't let it overstate the strength of the consumer. It's good. It's helped hold up growth, but it also masks that other shift. And we've gone through effectively 5-6 years maybe of the transition to e-commerce in a space of a matter of months, right? So going into this, about 20% of sales took place online. It's now close to 30. It's about 28. Let's be reasonable. That'll probably come back a bit as shops reopen and people readopt old habits, but it's still a marked change in a short space of time, and it's unpleasant and for a lot of people employed in bricks and mortar retailing, because there's it simply means leads to stores closing down, and we've seen that, and it's coming through in the data. So the number of retail outlets closed in the first 2/3 of the year had already matched 2019, which itself was a harsh year for retail closures, as we know. So that's the story there, sort of accelerate, and that word that we use a lot to think about the structural shifts that COVID implies and is bringing out. It's accelerating a lot of trends, the shift to digital, both in terms of working from home, as we are evidencing here, and on the retail side. And those elements we think stick. They'll come back a little, but it's a sort of an accelerated period. What might have taken place over 5, 6, 7 years or more has taken place in a number of months. And anytime that happens, it's the economy, the adaptation on the labour market side just cannot respond as quick, because it's not in human nature, and so you end up with people losing jobs. Hospitality, hotels, aviation, I group these together because the impacts are just so pronounced. It's quite difficult to believe. I'm still shocked when I look at the scale of decline in flights compared to normal. We're actually close. So looking at them last week, we're not far off the lockdown lows for the decline in flights in the UK. Now, that's staggering. As if anyone's been to an airport recently, you'll see it's truly frightening, because it's like stepping back in time to sort of 1970s or 80s, or how I imagine airports were then. I'm not old enough to remember. And so the recovery from there is a long, long way to go. Pent-up demand, yes. Money on the sidelines, yes. People keen to do those things that are causing considerable suffering in these sectors, yes, but it's showing up, and it's really showing up in the southeast. Where were the local authorities where earlier in the pandemic where the take up of the furlough scheme was most pronounced? Well, those local authorities were the ones surrounding airports, Heathrow and Gatwick, right? So that's that's really telling. Which region has seen the biggest decline in workforce jobs over the past year? It's the southeast, and my guess is it's to do with aviation, even though I don't have the data to truly confirm it, because it's hard to come by. But look, that doesn't, I don't want to be negative on the region, because you can't be, because it's incredibly successful. The proportion of high skilled jobs is remarkable. It's been a tremendous success story. It's gone from strength to strength over the past decade. So there's a considerable strengths to the area, and they will really come to the fore in the recovery. Skills bias, technical change, the southeast is at the vanguard of that, and all the various sub-regions. But that's certainly a challenge. And so the quicker that gets back, the better. And it requires country cooperation, it requires standards on tests, and certainly limiting, as we do now, the period in which people are required to stay at home and self-isolate after having travelled. That needs to come down, otherwise you can't reinvigorate the industry. So it looks like you've got the makings of a recovery there, and that will accelerate sharply post-vaccine. On the lending side, I mean, this has been really, really interesting. It's sort of when if you're looking at it as a bank analyst, you think, well, this is remarkable, because this downturn's been so incredible. It's blown past everything that we've seen. But you look at credit outcomes, and they're just not concomitant with that, right? Because it comes back to policy, the success of the job retention scheme, supporting incomes, and things like the coronavirus business interruption loan scheme and B-bills, and how they've provided liquidity support to so many businesses. And they've just been hugely successful in sort of putting a barrier down between tremendous economic fallout and sort of credit strain and stress. And that's the case right across banks. Yes, they're provisioning, they're putting aside lots of money, as is prudent as they should, but so far those credit outcomes just haven't come through. And here's another, and that feeds through to what's going on in the housing market. You would think, my word, this is going to be really bad news. In fact, it's the opposite end of the spectrum. There is a mini boom in housing that has legs. It really does. If anything, house prices are going to accelerate in the coming months. Perhaps the highest seen for a number of years. Pipeline of activity, law mortgages coming through. Yes, it'll cool in 2021. But again, in an upside scenario, it possibly doesn't cool by that much. Rates and inflation. What to say here? Look, it's market pricing lower for longer. You're not going to get a rate hike for 3, 4, 5 years, as so far into the future. It's barely worth talking about, and inflation expected to remain low. What I will say about this is, and many who've heard me speak before, I've year after year been at pains to underline, lower for longer, low inflation remain low, you can't get rates up off the floor. That's the world we live in. Events like these, history tells you, sort of paradigmatic change, they can herald. The chances I attach to moving into a higher inflation environment, and therefore by extension eventually higher rates, the chances of that have risen. Let's be clear. And again, it's about policy and the sheer weight of fiscal money flushing through the economy, the increase in the money supply that's coming through. That those things combine. We're sort of moving closer to helicopter money. In a way, we're already there. Those two things combined conspire to increase inflation, and then for eventually rates. So it's not the central case, but the chance attached to it have risen. Market pricing say in central cases, rates low for a very, very long time, because it will be required to support the recovery. And then on the global side, look, lots to talk about here. So very briefly, quick whip round. US took a different approach. We support jobs, and Europeans did likewise with income support. US let the labour market fallout unfold and just supported the large levels of unemployment, extremely generous unemployment support. That needs to be extended in some way in the very near future, otherwise the US is going to slow sharply. Its recovery to date has been good. I think economic output is 3-4% below its pre-COVID peak. We're about twice that. So that, you know, they've engineered a good recovery so far, but there is, well, first and foremost, in sort of Rocky Mountain states, you know, the pandemic's really sort of taken hold and restrictions are being dialed up, but it's this need for fiscal support that's required. Eurozone, similar to us, really, really good, strong summer rebound. That's come to a premature end because, you know, because of second waves. But at least in many countries, that those second waves are really getting on top of them. France, it's been quite remarkable over the past month. Their second lockdown has been tremendously effective, and they're loosening from the weekend. Spain, big rise in infections through October. They've reversed that in November, again through dialed up restrictions. But long way to go. To try to touch on briefly, but the tensions at the heart of the Eurozone project have not gone away, despite them having a good crisis in many ways and making steps towards fiscal union or some more of the needed infrastructure in place as part of a monetary union. So it's been a decent crisis for them so far. You know, made considerable progress on that, but a long way to go. And the challenge and recovery in Italy and parts of Italy and Spain is truly staggering. China stands out. It's already regained its pre-COVID peak and it's growing strongly, and it's going to have a positive year growth for 2020, which is itself remarkable. And I know you could think about it as maybe quite clever because they focused, rather than focus on the consumer, they focused on the supply side, so getting factories moving. And what that enabled them to do was to respond to the demand need in the West for medical devices, technology for working from home. So the export sector rebounded strongly, and they've actually captured greater market share in world export markets. And then the other piece of the puzzle, the consumer, that's really getting moving now. So it's, yeah, they've put together a decent recovery to date, but you don't get the news flow out of China. It's extreme, as we all know, closely controlled. South Korea is suffering an outbreak and having to tighten restrictions. I think there's certainly pockets of it in China. You don't get the full story. And the measures which they use to stamp down on it are often quite jaw-dropping. But it's, you know, in this world you can't say the story's finished. But let's be clear, strong recovery, very strong recovery to date, and prospects good in 2021, really leading the global recovery. Right, that's a quick whip round. So I have a couple slides on the housing market, just to underline this point about, you know, how strong it's been. Mortgage approvals for house purchase, highest they've been since pre-crisis. Gross mortgage lending recovering. It is higher value houses and bigger houses, and that all makes sense. We spent months evaluating our premises and thought, right, okay, we maybe need a bigger house. I need more bedrooms. I need more space. We're living in the country, or we're living in a smaller town away from cities, and many people acted on that. So pent-up demand played a big role in the housing market recovery, not just stamp duty cut, which is helpful and important, but pent-up demand was really, really clear, and those who wanted to shift out. Sorry, this is on the next slide, I should say, moving along, so you can see mortgage approvals top left, gross mortgage lending, and then this house. The volume of house purchase mortgages, and it's really on those, you know, houses valued 500,000 and above, which is small being in the southeast, I know, but taking a countrywide view, it's big, given the average price of a home in the UK is 250. So yeah, and then house price growth for depending on house type and detached is seeing the strongest. And then on the next slide, just to underline this point. So just moving on the next one. This point about the expectations for the next few months. So Royal Institute Chartered Surveyors, probably the most closely watched survey of housing market sentiment, does indicate an acceleration. Do I think it's going to go rocketing up to 10% or more? Possibly not, but as I say, good reason to believe it's going to go up a good few percentage points in terms of house price growth over the coming few months. And expectations are for cooling into 2021, as I said, and the price correction being very modest, 2-3 percentage points. It's not much at all. You could find that in a normal year in a non-COVID world. But just a couple of things to flag as to why cooling. Demand's going to be coming off a bit. High frequency indicators again, bottom left chart. It's it's early days using these, so not to put too much stock in them, but sort of Google searches for Zoopla on the market, etc., have come off, and look, rates have been ticking up for higher LTVs. So that's something that potentially throws sand in the gears of the market. Right, that's enough on the housing market. On the next slide, so I'll just touch on a bit of this labour market. Already covered really September. Bottom left chart, big increase in redundancies matching the financial crisis. To date, young have borne the brunt of the labour market fallout. That's expected to remain the case. But this also comes back to the point on the housing market. Why is there this expected insulation given the economic fallout, given the decline in unemployment? It's where the job cuts are set to come. Somewhat, it's maybe gets to the point around inequality and unfairness in the system, but those expected to bear the brunt, younger, and the sectors in which those people work, are not active participants in the buying and selling of houses to the same degree as other older workers, those in white collar jobs. That's unfortunate, but it's sort of cold hard reality of it. So that's one of the things why forecasters have that modest decline in house prices penciled in. And as I say, look, the bottom right at this point on lower peaks, later peaks in unemployment, and so raising the chances that the vaccine comes along and you bridge the gap and prevent sort of more material damage to those in employment. Right, very finally, before I stop for some Q&A, just to zoom out and almost talk about something else than so UK focus. So on the next slide, I set out a couple of just interesting charts, so thinking about some of the angles of the incoming US President Joe Biden. And look, trade war will feature prominently, I expect. It might not be undertaken so publicly and through the medium of Twitter, but the trade war in some form actually, it predates Trump, Obama and team. There was lots of discussions behind the scenes for a number of years on China's practices, its support for state firms, and issues around intellectual property. It just wasn't taking place in a public forum. Now, the problem with when you impose tariffs and conduct trade wars and you aim them at a country is supply chains are really, really nimble. That globalization has enabled this kind of pulling apart of supply chains, and so they're very, very nimble and responsive. And you can see it right here. I've chosen Christmas lights because it's topical. But basically, the US is sourcing much more of its Christmas lights from countries other than China, Vietnam, Cambodia, Philippines, right? So it just underlines this point. It's quite a nuanced issue. And so more generally, the electronic exports from Vietnam to the US is, just increased dramatically. And so even sort of less clothing, so that's probably going elsewhere to some extent. And the electronics bit, so from Vietnam's perspective, moving up the value chain. But it's this point about trade deficits and but also about, because this is not countries acting alone. There is the supply chains that exist that have built out from China through its near abroad, its hinterland, and that makes sense because the same thing's visible in Europe, and the same thing's visible in North America. It's very, very clear in East Asia, Southeast Asia, big deep supply chains, and that's what's happened there. On the bottom couple of charts, I find this quite interesting, and at first blush you might think, right, what on earth is going on here? I've never heard of these firms, or some of you in the section I'm sure will have. Something quite interesting happened over the summer, and it probably didn't get the attention it deserved, but effectively so Intel always been sort of the technological frontier really in semiconductors. Effectively over the summer there was confirmation that they've lost that lead to TSMC, so a Taiwanese-based semiconductor manufacturer, and that's been reflected in their market cap, and quite convincingly so. And that's really, really important because in this age, in the information age, the movement around of data, how quick that can be done, and the number of and how powerful the phones in your hand is. So it comes back to this. So what was oil? And on the chart on the right, you can see the market cap of all the energy firms compared to all the firms operating in semiconductors. Well, it's surpassed energy, right? So it's the information age very clearly showing up, and the way in which we achieve growth very, very, clearly showing up in markets. And there are big geopolitical consequences, because what was fault lines that previously ran down through the Middle East that were the focus, well, it probably shifted, and maybe they shifted to the Taiwanese Straits, where there is, as we all know, over decades, tensions of some sort. China views it firmly as part of China. Not many countries recognize Taiwan as an independent country, very, very few in fact, but it, to all intents and purposes, effectively operates as one. And so that's potentially a real flashpoint for this presidency and presidencies beyond, because this is the information age and the fourth industrial revolution and the rollout of AI. These are the semiconductors are the means through which they're the oil. That and well, data, but semiconductors are sort of finesse that in a way. So that's the story there, and I think it's so warrants plenty of attention and plenty of reason to expect sort of tensions to simmer in that area in the coming decades, years, months, decades. Okay, I think I shall end there. Talked enough. Questions on any of that? I know there's a lot in there. That's quite a bit.
Well, thank you, Marcus. Sorry, thank you, Marcus. That was really excellent. The only thing I'm going to pick you up on is, as someone who remembers the 1970s, you'd have to go back quite a bit further than that to find Gatwick Airport as quiet as it is now. Otherwise, you will.
Oh, really? Yeah, right. Okay, yeah. That's
okay.
Right, yeah.
Can you please, everybody, put your questions into the chat, or wave your electronic or real arm hand if you'd like to ask a question personally, and we will try to pick that up. We have got one to get us started. Marcus, a little bit like the Chancellor yesterday, I think you managed to skip Brexit.
Yeah, so really good.
Yeah. So sorry, you're not going to get away with that, because our first question from Neil Fantham Hodgson. Neil says he'd always thought there was going to be a V-shaped recovery from the impact of COVID, with the massive pent-up demand and huge increase in money supply, things you've mentioned, of course. But surely the biggest threat is now to deal with Brexit. So I'm sure you were expecting this. The two things going on together. Give us your insights.
Yeah, it's a really good question. So our stance on this, and really the OBR yesterday, sort of very helpfully sort of lend support to it, was a no-deal Brexit. The impacts are better thought about almost at the sort of individual sectoral level and indeed the business level, because in forecasts we set out here and forecasts across consensus, the impacts of Brexit almost pale in comparison to what to a recovery from a pandemic, because the numbers are so large. And so to just underline the point, so the OBR said yesterday that a no-deal Brexit makes you still get growth, and it's just not as much as you otherwise would have been. You're talking about percentage points, but you're growing. Your expectation you're growing at 5, so you might only grow at 4 or 3. Now in normal times that matters, and it matters a lot. But it's pulling it apart from a recovery from a pandemic. In many ways, it almost amounts to a sort of margin of error. And given that the OBR didn't set out one solitary scenario, they set out 3 with a big distance between those 3 scenarios. So yes, no-deal Brexit has an effect. It'll make the unemployment peak higher. So rather than 7.5, maybe more like 8, 8.5, 9s, and growth that bit slower. But they don't fundamentally alter the shape of the recovery from the pandemic. Where the debate really lies is what it does to you in the medium to long term. How much does it affect your ability to grow? And that will come back to the nature of the eventual deal that we have with Europe and other countries. How open we are to migration, because population growth is such a big factor in generating economic growth. So yeah, that's the tricky bit. The tricky bit there. So yes, there's an impact. Yes, it makes the recovery more challenging, but it doesn't fundamentally alter it because of the sheer scale of what we're experiencing.
Okay, thank you, Marcus. Before I go to the next question that's been put into chat, I just want to ask you something a little bit more specifically about our economy, the Gatwick Diamond economy, because you were fairly optimistic in parts, actually, about the underlying conditions and the expectations of growth. The issue, but one of your slides was particularly relevant to us, and that was your sector slide, where you showed the disparity in terms of sector impact, and you mentioned in the southeast, and this applies in the Gatwick Diamond in particular. The reliance on the aviation sector is clearly a huge factor. And in terms of jobs, for example, the extension of the furlough scheme to March came too late in terms of Gatwick Airport and in terms of other aviation and airline businesses. And the recovery of the airport, going back to that, 2005 probably, before we get back to pre-COVID levels. So my question really is, could you comment more, say a little bit more about that sort of regional impact on economies, well, such as the Gatwick Diamond?
Yes, a really good question, and it does, it stands out, the decline in workforce jobs across the southeast, which we expect, really, you very quickly hone in on the aviation sector. Look, the sector's big. It really matters when you lump together airports, airplane manufacturers, and all the suppliers to that. So think ground staff and think catering and think the shops and the bars at airports and what have you. This sector really matters. It's about 5-6% of GDP when you lump it all together. And I'm talking about airports across the UK as a whole. They are big generators of jobs. They're labour intensive. They're hubs in themselves. Gatwick and Heathrow are economic hubs in themselves, and they generate activity and productivity. So they do really matter. And so because in the case of the southeast, there are so many positives in other sectors. There's broad-based success. It will hold it back, but not to the extent that it otherwise might have, because of the strength of balance of across other sectors, including ICT and professional business services. There's so much success and high productivity, but it will be, like you say, it will be a laggard. It could take years for it to recover. But my long-term view remains, right, put this aside, does it, the desire to travel year after year comes through, in emerging economies, as their middle classes grow, what do they want to do? They want to travel. They're so eager to do so. There are millions every year of Indians who are taking their first flight. It's coming through in the data every single year. That desire doesn't go away. It will recover. And our population growth, while slower than what we've experienced for the past decade, is still firmly positive. And it's a desirable place to come and visit. So I am optimistic about the sector as a whole, beyond this short to medium term. I really am. But look, it's difficult in the near term, and it's difficult for the people that work there, particularly because it's hard to go and get a job elsewhere. How nimble you can be to go and pick up a job in the interim is challenging. Retraining takes time. Previous rounds of deindustrialization tell us that people need support and help to do that retraining, to go and get into other growing sectors, and that many will unfortunately fall between the cracks. And that, as I say, we're getting signs of that because of what I was saying about September and the big pickup in redundancies, that we saw there.
Okay, thank you, Marcus. I have a question from, let me see, where shall I go? I'll go to Peter Booth. Peter Booth has asked, do you think that the shock of COVID will push UK SMEs to hold more capital and hence invest less and retain earnings rather than distribute? So will they hoard or invest?
Yeah, so really good question. So our expectation is that it will, investment picks up late cycle anyway. So there's going to need to be, real evidence of a strong recovery before that. You sort of revert to, large levels of investment and distributing capital. I think there'll need to be, evidence that recovery is there, because I think that precautionary behaviour's very clear for all to see. Significant drawdown of credit lines and taking advantage of C-bills, B-bills schemes. And we see that those cash piles growing dramatically. I've never seen them grow so dramatically across UK PLC in the months over the spring and the summer. And there's a lot, they're just sitting there. So yeah, you're going to need improved conditions, and so, I think consistently so, before there's confidence across the piece to fully invest and distribute. And as I say, but this is customary with any forecast from a recession. Investment picks up late cycle.
Okay. Thank you, Marcus. I have a question from Jeremy, which is too complicated for me. So Jeremy, would you mind posing the question yourself? He's now hiding. I can't see him. Is he waving his hand? No, I'll attempt to cover it then. He says, will there be a Brexit dividend to help pay some of the whopping 394 billion of borrowing we have built up this year, according to the Chancellor's spending review yesterday? That's a much abbreviated version of his question, but...
Brexit dividend. So, look, I think what's coming through in the data, like the last time in the run up to the sort of previous deadline, activity is being brought forward. So actually, manufacturing, and I had it on the chart there, in contrast to services, had a sort of improved November. So what's going on again is that stockpiling, fulfilling orders in advance of the December 31st deadline. And that's on both sides. That's European firms placing orders with UK firms, and UK firms placing orders with European firms. So there's a bit of a fill-up there. I think there could be, because when businesses are asked about uncertainty, Brexit's coming through, and it's one of the reasons the uncertainty around the outlook rose over the autumn. It wasn't just about the sort of building second wave; it was about Brexit as well. So there's a bit of dividend in that sense, but sort of similar to the question on impacts of Brexit, it's modest in and around the recovery from a pandemic. What matters by far and away and by some distance is vaccine rollout, that it's speedy, effective, and that people return with gusto to the sort of consumer-facing services. And that that's the big driver: consumer-facing services and travel, as we discussed. Yeah.
Okay, well, thanks, Marcus. Moving away from Brexit, commercial property. Stuart McLennan has asked whether you have a view on the impact on commercial real estate values, and again, will demand decrease in inner cities and increase in the provinces? So your views on the commercial market?
Yes, it's a really good question. I've done a bit of thinking about recently. So yesterday, OBR, in the plethora of assumptions they set out in their detailed economic forecasts, they assume a 10% decline in commercial property over the next year, or sort of 10 to 2021. Other figures, other notable forecasters going a bit more. So I've seen a 16% figure. But that masks, as you sort of tease out in your question, very different experiences across sectors in particular. This will be a continuation of a major shakeout in retail. All capital values declining already and have been for 2 years across retail, 2018, 2019. It accelerates this year. It goes on next year. And actually, so one forecast I was looking at, an acute price correction this year and next, but the price correction ongoing through 2022, 23, 24. And that is structural change, and it's hitting squarely shopping centres and retail units. That's where the damage is most acutely felt. And that's, comes back to my point up top about the shift to online. And the flip side is another key subsector within CRE is industrial, and within that lies logistics. Logistics take up this year strong, so there's your flip. So job creation in logistics and warehouses and distribution, while jobs are being lost in bricks and mortar retail. So there is a sort of good news story to flip side to the bad, and so that industrial sector is expected to be the relative outperformer. In fact, you don't see prices decline in terms of that subsector forecast. There's a negligible decline this year. It's all pretty steady, and then in between those two, between retail, which you can see 20-30% decline in prices for, let's say, industrial flat. In between those two lies offices. Because again, structural change a big factor. Working from home in the bank, and as are the vast majority of my colleagues, and that's an element of that will stick. And so, as we all know, simply the need for commercial property to the same volume as before will be less. But what's come through in the market, and this is interesting, is there are demand coming from other areas. There is growth, and there's still a bit of optimism around the sectors that are growing. So on the tech side, maybe in other parts of business services, the demand's coming through. Good quality, yes, but I think compared to earlier in the year when it was, this is an absolute game changer and it's a bloodbath, it's moderated somewhat, and so still price decline 10, maybe 10-15%. Judging by sort of key forecasts I've seen in offices, but not as much as some of the figures that were banded about earlier on.
Yeah. Thanks, Marcus. Certainly around Gatwick, what we're seeing is a strong demand for logistics, sort of high-end logistics, which mustn't be dismissed as sheds, as we rather pompously once did. There's much more.
Absolutely,
than that. Yeah. Right, moving on to a question I'd really struggle to answer it, but I'll try and ask it. What about the value of the pound in your pocket? What is your view of the trading ranges for the pound versus the US dollar and the euro? And the reason behind the question is because of the importance in terms of the impact on exports.
Yeah, so look, as ever,
it's another really half hour.
Yeah, it's tricky. So we don't have much movement from here, I have to say. And that's kind of across the piece, across consensus. I haven't looked at the forward curve recently. I will probably show something slightly different, but I think consensus is pretty steady from here across euro and US. Look, we all will be keeping policy. I always like to bring it back to fundamental differences in policy. We'll all be keeping US, Europe, UK policy extraordinarily loose. Rates low, more QE to finance government deficits. So it's all kind of pushing down. That's all downward pressure on currencies, and therefore I don't see somebody breaking free from that and going on or even indicating that tightening's coming down the line. So that's really why it's steady from here. $1.30, €1.10, whatever. That's effectively the forecast from here.
Thanks, Marcus. And I've got what might have to be the final question from John Martin, but it takes us into an interesting area because John mentions how his business is invested in software, now operating much more efficiently, higher service levels, lower staff numbers. It's interesting because I was going to ask you a question, had there been time, about sort of positive restructuring, a sort of an acceleration of change process through businesses and the economy. Sometimes we need a good kicking in order to do things perhaps we should have done before. So do you have any views on that, the positive impact in terms of an acceleration of positive change?
Yeah, so that's a really, really good question. And so from an economist, you look to evidence that that's the case in past recessions. And you do find that the period immediately following, so you're talking 18 months from a recession, is the period in which there is sort of that labour replacing technology. So the downside of that being is, accelerated period of losing jobs to technology, but it points to firms. There is a bit of a shakeout, and it sort of sharpens the senses, so to speak, and that comes through. That comes through in the data. That has been the case in past recessions, particularly the US, but the UK as well. So yeah, so interesting to hear that, and as I said, it does chime with past experience.
Okay, well, that's great, Marcus. We're just about there. I'll just quickly ask anyone who's put a question and Marcus has responded to. Would anyone like to come back on Marcus's response or expand on their point? Or shall I take it you were entirely happy with everything Marcus said?
Hello, it's John.
Hello, John. Hi.
Yeah, I think what's made this different for us is that the uniqueness of the fact our business just disappeared, well, basically for a year, and that meant we had time to do stuff that we wouldn't otherwise have even tried to do in terms of process changes and stuff like that. Now, I appreciate not everybody's in that position, but it's been a really unique opportunity, which a normal recession or something would not have allowed us to do. But we've been forced to look at our processes, and we've had a chance to do all sorts of trials, which we wouldn't be able to do if we were running the business at the same time. So that's what's made this different for us. And I'm old enough to remember 80-81 and what that was like. And this is a different ballpark again.
Okay, thank you, John. Well, we are now out of time. So all I'd like to do, first of all, is to thank colleagues at NatWest, Paul McConalogue and John Feldmanis for working with us to put this briefing on. And of course, Marcus, finally, to thank you. Excellent as ever. And, we look forward to seeing you back in maybe different times, next year sometime, maybe. So I think everyone would want to join me in not a virtual, a real round of applause for Marcus.
Thank you, everyone.
So they didn't have the initiative to unmute for the applause.
I can see it.
Can't have everything. Okay, well, thanks to everybody. See you all again soon, hopefully. Bye.
Cheers.